The headlines are screaming about a recession, and the US market is showing some serious cracks. But is a total crash inevitable? Today, we're cutting through the noise to show you exactly how to protect your portfolio in 2026. The reality check. With the Federal Reserve's latest stance on interest rates and rising consumer debt in the UK and US, the soft landing everyone hoped for is looking shaky. High interest rates are squeezing businesses, and we're seeing a shift in how the big players are moving their money. Step 1. Cash is king. Again, don't keep all your money in risky stocks. In a volatile market, moving a portion of your portfolio to high-yield savings accounts or Treasury Bills is a smart move. In 2026, some of these are still offering solid, risk-free returns. Step 2. Quality over hype. Stop chasing the latest meme coin or overhyped AI startup. Focus on companies with free cash flow and real products. When the market dips, these are the assets that recover first. This is the time to build your buy the dip watch list. Step 3. Diversification is your shield. Don't put all your eggs in the US market. Look at international ETFs or commodities like gold. Diversification isn't about making a killing, it's about making sure you're still standing when the dust settles. The market rewards the prepared, not the panicked. What's your move for 2026? Let us know in the comments. Subscribe to WealthWire US for your daily dose of financial clarity. Stay smart, stay invested.